Welcome to the daily update, where I'll go over the action in the market for Tuesday, November 5th. Then we'll see how things look for Wednesday, November 6th. After kind of a difficult weekend with what was going to happen with the election, it seemed like things were a little bit more under control as election day started to unfold. And the market really liked that. And we ended up bouncing. We're still below the 20 period simple moving average, but we're well above now the 50 period, both the simple and exponential moving averages. And as I record this, it's not official yet, and it could change by the time I get done recording, but it looks like President Trump does have a comfortable lead, but there's still a number of states that haven't officially called anything, and it's leaning more in Trump's direction, but we'll have to see. The longer it takes, the more doubt there could be about what will happen. At this point, it looks like the Republicans will take over the Senate. They may lose the House. It's kind of right on the edge right there. We'll have to see how that works out. And the market would like that. They would like a divided Congress. If you're more of a Republican or conservative or lean more towards the right, you want Republicans across the board to try to get in there and fix what they see are the problems. If you're on the Democrat side or more to the left, you don't like what's happening right now, and you want to at least probably hang on to the Senate to make things more difficult. There's been some changes throughout the states, but again, even though we live in this advanced era of technology, it seems like things are more complicated than they used to be. But so it can take things out. But nobody at the time I'm recording this, it's after 12:30 a.m. Eastern time, which would be 9:30 p.m. still West Coast time. Nothing has been declared, but that could change at any time. So I just looked at the futures before I started recording, and they're up almost 1.5%. So they like what's happening with all of this. But as I always say, they don't really care if it's Democrat or Republican. The stock market themselves, and this could be just an emotional reaction that could change quickly, but they like a divided Congress just because they want to tie up Congress's hands to be able to, usually what they do is pass more rules and regulations. So, okay, but I waited longer to record this video because I didn't know how things would unfold. I wanted to try to get as clear of a picture as possible. It's still not there yet. So I've been really paying attention to things anyway. I find it of personal interest. I do have a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. Please feel free to check that out and see what you think. You can go to the website. There's a link. You can go to a video. There's a link. You can send me an email. And one of the benefits is if you're listening to this video after the close on Wednesday, everything I'm saying right now is out of date, where if you belong to the program, you're getting this as close to real time as possible because I upload this right after I'm done recording, and members in the program get access at that time. Also, the daily video is what I really do my analysis on, with all the weekly videos feeding into the daily video. Okay, so we had a higher open. Once there was a thing in what was it, Iowa, that came out over the weekend that was really different than what had been seen leading up to the election, and that threw all the betting markets off. That threw uh, everybody kind of into a tailspin because it really looked like things were shifting throughout Monday and then into Tuesday as election season got going, or the day got going. It seemed like that was more of an anomaly rather than a real shift. And so the market ended up having a higher open. They liked that. And prices climbed above R1 at 57.37 and got up to R2 at 57.62. We even got above R2, but we kind of stalled out at that 57.75 level. That's about at, not for the S&P, because we got above the 20 period exponential moving average and we didn't quite hit the 20 period simple moving average, but some other indexes. That was kind of the high point there. And so we leveled out there. but we ended up closing at the high. So it ended up being a positive day. We were up 1.23%, but volume was below average. We'll have to see how volume kicks into gear, if at all, in Wednesday's session. Thursday is going to be the next big day with the Fed coming out with their announcement and looks like a probable rate cut. And then we are still negative. And I measure this by the simple moving average. We're above the exponential, so that's shifting more positive in the short term based on 20 periods, but we're still below the simple period, the simple moving average based on 20 periods. And that's what most people use. Over the years, most people tend to use simple moving averages other than exponential moving averages. We'll see how things play out as far as interest rates. Inflation still seems to be under control. Everything is focused right now on the US election, even though there's things going on worldwide. That could really shift the whole dimension there if things continue in the same direction as they appear to be unfolding in the US. But nothing is even definite in the US at the time I record this. So we did see broad-based advances in Tuesday's session. Growth had a pretty good day. And the 50-period moving averages, both the simple and exponential, they're holding. We're above that now, but we're still under the 20-period simple moving average. The VIX did decline, but we're still over 20. So we're still getting a high reading with that. We're watching what's going on in the Middle East. And now we're back to having our 150 and 200-day simple moving averages looking extreme positive. Now, they're above the line that I put on the chart, so that's nothing magical, but this could also suggest, okay, the long-term trend is still hanging in there and looking positive. And we'll see what the Fed ends up doing, but over the weekend, I came out with the Fed Watch tool probabilities, and it's almost like 99% that they're going to cut rates 0.25% at the meeting on November 7th. The dollar was down and interest rates were down. This helped give some support to stocks. We're at 4.29% with the 10-year yield, where we had been at 4.31%. We're still inverted with the 10 to the 3-month, where the 10 to the 2-year is still uninverted. That hasn't changed. And sentiment, I forgot to look that up. I've been rather distracted here, so I didn't get a chance to check on sentiment. It probably improved. We might be getting close up to that neutral area. We are still negative with our trend, though. The ADX, it's trying to turn up, but with the update, it's starting to go back down slightly. So we're below the moving average. So we're still in a weakening trending environment, but we're above 20. So we are trending. The bias is positive, and now I've changed the momentum to mixed because we'll have to see with the solid update that we saw on Tuesday. The futures are looking good right now. We haven't switched back over to complete positive yet, but we are showing some improvement here. We did get the trade balance report. It came in as more than expected, being down 84.4 billion. That's more than the minus 74 billion that we saw last time, and also down from the 70.8 billion. The S&P Global US Services PMI, the takeaway from this is it came in at 55. That's above 50. That's showing expansion, but a little bit lower than the 55.2 that we saw last time. The big one, and the market seemed to react to this positively, the ISM services, or non-manufacturing, depending on how you look at this, the PMI came in at 56. And that was much stronger than the 53.5 they thought was going to come out, and up from the 54.9 that we saw last time. So this is showing growth in the services areas. And as I explained from time to time, that's the foundation of the U.S. economy now. We used to be a farming type of culture. Then that switched over during the Industrial Revolution in the late 1800s. Then we started to manufacture things. And we did that until after the end of World War II. And gradually through the 50s, 60s, 70s, 80s, 90s, getting into the internet age, we've shifted over to more of a services type of economy. And so seeing growth here, since it's the biggest part of the U.S. economy now, is showing solid strength. Here is the monthly nominal trade balance, where we're negative. You can see the numbers they're all red over here on the left, and it just shows that there's more debt that's being piled up here. And this is the 3-month average of that. And then looking at nominal exports and imports year over year, we're seeing an increase in the imports, which is not necessarily surprising because we get these manufactured things from other countries. And then the exports, well, they're still strong, but this is actually going down. Nominal trade deficit still going down, more negative than what we've seen, at least on this chart. And the ISM services index, the total is going above 55 and actually showing some growth here where prices are coming down. And you combine those two together, and the market liked that. They like that prices, which is inflationary, is coming down where growth is still going up. All right, then looking at the overbought, oversold composite, still coming in at 70.2. We're working off. We're not really at a real high level right now, but it has been coming down. We're seeing this also, we had been seeing this in our other sentiment gauges as well, and some of the indicators that we look at. We have nothing on our short-term list now as far as being oversold or overbought, other than the long-term moving averages. And there's just a bunch of gobbledygook here. This takeaway from this stocks of what they've done around election day, and I have another chart to show you later, where in the next month they're up 58.3% of the time, so a little bit of an advantage to the upside. When you go out 3 months, it's up over 70%. 6 months, it actually drops down a little bit. And over the next year, it goes back down to where you would have been. So there's really no, when you look at the median and the mean and the average and all these, you don't really see a big change. But during the last 10 elections, because the whole culture of America has turned more political, the more you look out, 60% next month, 80% in 3 to 6 months out, and 90% up a year later. So it over the longer term, not as much of an impact, but over the last 10 elections, which would be the last 40 years or so, there has been more of an impact. All right, then this is kind of an interesting, well, I haven't shown a chart like this before. This is the difference between realized and consensus estimates of the S&P 500. So this is, the consensus is what they thought would come out, and then realized is what they actually reported. And it's actually coming up a little bit here. And so it just, you could take this as a little more positive in that we're seeing a little higher reading here, but you could also take this as negative because that means these estimates are missing a little bit more. And but that's what's baked into the market is what they think the estimates are going to be. And so that's where current prices are at. And this is a kind of looks like the Arun indicator that we use here. The takeaway from this is that this is a type of sentiment gauge here. We had been becoming quite positive here. We're dropping down. We're actually getting a little bit lower reading if you look over here on the right-hand side. So this is suggesting that sentiment has declined, at least as far as I can tell. And then what's the probability of a recession? It is dropping. When we see this chart, then happy new month, the log scale. This is a 10-month average. This is why I don't include this in the seasonality, because this is one of those longer term charts where we're still looking good just when we look at a daily chart, but we're seeing things actually looking fairly positive going forward. And then the VIX, we're still above 20, even with the up day. We'll have to see if we have an up, at least open in Wednesday's session. Is the VIX going to fall below 20? Well, we've had a number of days now with the VIX above. This says it's 200-day moving average. And I do plot moving averages on there, usually shorter term, but we're still getting very, very high readings with the VIX. And then cyclicals versus defensives, we're seeing some improvement here. Where in the US, that's the dark blue line here. This just means the economy is doing better, and these types of stocks tend to perform better as the economy is still looking pretty solid, and that's why we're seeing these going up. And then the chart of the week here, and this is a little bit misleading because I think it was in yesterday's video I talked about how the 60-40 portfolio, where you have 60% in stocks, 40% in bonds, it's really taken a hit lately and really underperformed. But when you compare it to gold and the 3-month T-bill, it looks like, wow, look at how good this is done. And it's still respectable. You get an annualized return of 9.1%, which does not beat the returns of the stock market over what we've been seeing lately. And you do see some volatility in here. Is this annual volatility or is this volume? Okay. Anyway, so this just shows you because a lot of people set up their portfolios like this. They spread it between stocks and bonds. And you read a lot of books about this, how to set up a long-term portfolio. And this is what they suggest. Well, over the last few years, it's really, especially 2022, the 60/40 portfolio just got hammered, not only by stocks going down, but bonds went down even more. Okay, yeah, there's things all over Twitter, but I didn't really find anything because so much is up in the air and it's all about the election. Yardeni hasn't really posted anything of interest right now. So here is the intraday chart where we opened up and immediately went above R1. We got up to R2, went above that. We stalled out at around the 57.75 level, fell back, just kind of went sideways, but then saw a little bit of an up move going into the close, then closed at the high for the day. And we're up strong now with the initial overnight session. So, as I said, when I started recording, it was about a percent, 1.4, 1.5% of an upward move. So the market likes what's happening right now. That could always change. We can just go with what we see happening at the current time. This is still positive too, where we have the blue line above the red line on the intraday chart of large cap growth versus large cap value. We're seeing a little bit of an improvement when we look at S&P growth to value. It's hanging in there and still having a tendency to go up overall. So on an end of day basis, growth was up more than value for the large caps. It was up more for the mid caps and up more for the small caps, even though everything was pretty solid. It was a broad-based advance in Tuesday's session on below average volume. So a little bit of an improvement, but still a downtrend when we compare small cap growth to value. Mid cap growth to value still in a downtrend, but improving and turning back up, still in an uptrend when we look at S&P growth to value. And coming up to the higher end, even peaking its head a little bit out of the rainbow when we look at the growth to value ETF. Discretionary to staples also looking pretty solid here. So this is more positive in the background of what we're seeing when you look at large caps and when you compare discretionary to staples. And large cap growth was up 1.5%, but it's still above its 20 period, 50 period moving average, but not back to an all-time high. It's got some damage to repair if it's going to be able to break and go higher. Our trend, we were starting to cross over with the ADX. Now we're starting to come back down slightly here. And the red line is coming down. So we still default to the negative trend, even though the red line's declining and the green line's coming up. We get a solid day on Wednesday. This has a chance of changing, but until we actually see that and we see what the close is going to be on Wednesday, we still default to the negative side. Also, coming back down after trying to cross over the moving average in the short term with the red line coming down and the green line going up. We did go below average with volume. So now we've seen Monday and Tuesday with below average volume. We'll see if it picks up in Wednesday's session. And we're still above the moving average here with the Ulcer Index as fear is increasing, coming down, but still above 20 with the VIX, and also coming down, but still above the moving average with the VIX of the VIX. The momentum of the VIX is still up, even though the MACD is starting to roll over. And here's the seasonal chart. After getting kind of a high reading in the early part of November, possibly this could drop. And if this goes down, this will feed into the positive seasonality that we see after the election finally gets over. We came down with this fear gauge, and we also declined with this other fear gauge. So we're seeing confirmation there of fear actually going away. Ticked up a little bit with the equity put call ratio on the daily chart, but we're still going up, but slowing down with the 5-day. We continue to go up with the 10-day chart. There's still fear out there. The volatility risk premium coming down, but still getting a very high reading. There's still anticipated risk going forward. Advanced decline line did see an improvement based on price and volume, still above the advancing moving averages. And we saw more new highs than new lows, but we're not really turning back up with our 5-day. We're flattening now with the 10-day. We crossed back above zero with the short-term advanced decline ratio. That's the blue line. And we just barely went negative with the red line, and that's turning back up as well, as we're seeing some improvement there. Turning back up, but still negative with the accumulation distribution. Also improving, but still negative with the Chaikin money flow, and turning back up after being extreme with the Chaikin oscillator. So this is probably looking about the best right now because we are getting an extreme reading. If this could continue to go up and bring the other smart money indicators with it, that could help switch things back to positive. Seeing things improving here, but still negative with the vortex. The red line's still on top, and we're seeing both the S&P going up and the NYSE advanced decline line going up. That just shows that it was more broad-based. The market really participated in that upward move, but we were still below average with volume. Seeing a bit of improvement with the accumulative advanced decline line for the S&P based on price, also a move up based on volume. The cumulative advanced decline line for the NYSE showing an improvement here, coming back above the moving average with the regular NYSE advanced decline line, also coming back above the moving average with this other NYSE advanced decline line, showing an improvement with common stock based on price and volume, and coming back above the moving average with the NYSE common stock, bouncing off the moving average with the S&P and the mid caps, coming back above the moving average with the small caps. We're still negative here with those stocks in the S&P above their 20-period moving averages, but improving and turning from negative back over to positive with those stocks above their 50-day moving averages, seeing an improvement above the 100-period moving average study and 200-period moving average study, and still bouncing up off of this 50-day moving average here when we look at the daily chart. But you can see on the bottom, we are dropping below the moving average there. An improvement with the 20, 50, and 200-day moving averages here. No longer extreme negative with the Stochk RSI. Also, the WIMS percent R is no longer extreme. The CCI 14 and the CCI 20 are no longer extreme negative. We don't have anything on our list right now because even the stochastics, short term, no longer extreme in the intermediate term, still negative with the longer term and crossing below the midpoint, but not giving us an extreme reading. The force index still hanging on to being slightly negative. And the condition of the short-term trend is measured by 20 periods here, coming back up above the green line. If we can continue to go up, that could help improve the condition of the short-term trend. And we're slightly above the exponential moving average based on 20 periods, still below the simple moving average based on 20 periods. And coming right up a little bit above the midpoint here with our standard deviations chart, seeing an improvement with the balance of power, but still negative. Still looking more negative with the go, no go with the lighter blue bars. Coming right up a little bit above the midpoint with the highest high, lowest low value chart. Then TTM squeeze just continues to say, nope, I'm not going to participate in anything positive. I'm going to continue to decline. Turning up, but still negative with the ease of movement. The Erin is still out to lunch. And we're no longer extreme with the McClellan oscillator for the S&P, although it is improving, but it's still below zero. So we're slowing down, but still declining with the summation index based on price and volume. Improving, but still negative with the NYSE McClellan oscillator. So we continue to decline with the summation index for the NYSE based on price and volume. Improving, but still negative with the Swenlin trading oscillator based on price and volume here. Momentum is still negative for the PMO, still declining based on price and volume. Seeing a bit of an improvement with the PMOs that are rising, starting to turn back up with the buy signals, flattening, but still declining slightly with the PMOs above zero. We've gone from negative to positive with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR. Momentum in the short term, still negative with the slope oscillator going down, still negative with the MACD declining. So all of our oscillators in the short, intermediate, and long term continue to be negative. The Copic curve, another momentum oscillator, is still negative. Improving, but still in this more neutral area with the Sean trend meter, still below 50 with the money flow index, going up but below 50 with the ultimate oscillator, a little bit above the moving average with on balance volume, and crossing a little bit above 50 with the RSI 14, just barely. It's pretty much at 50 right now, but slightly over 50 with the RSI 9. So you can see where we're seeing some improvement here, but we have not switched back to positive at least yet. The condition of the 50-period moving average, still below both lines. The longer we stay there, the more these lines are going to have trouble at least going back up. They'll only go up if price goes back above these lines. And we're still holding above the 50-period simple and exponential moving averages. Here's all the moving averages showing that we're improving with the 20s, still above the 50s. The 100s and 200s are still going up. Bullish percent index saw a little bit of a tick up, but overall, the context is that this continues to decline. Also, not really much of an improvement with the NYSE bullish percent index, but we did cross back over 50. So we've turned back positive with the NASDAQ 100 bullish percent index. Coming up to the underside of the mini rainbow, when we look at the 20-period simple moving average of the open, high, low, close, we'll have to break through that to turn back more positive in the short term. And I'm watching the Ichimoku cloud too. The blue line and the red line are pretty much even. We saw it's really hard to see, but the green line actually went back up slightly here. So we're improving, but not turning positive, at least yet. But we are still above this cloud. So that support level is still below current price. We're turning back a little more positive with the Heiken Ashi chart. We're turning positive now with the Kegi chart. It went from red to black. We're still negative with the Renko chart, and we're still negative with the three-line break. So we're getting a mixed picture depending on how we measure the trend. Long term, we've gone back above the red line with the 150 and 200-day moving averages. You could suggest that's extreme, but at the same time, that's just showing that the longer-term trend is still looking better. Positive across the board with the Keller market model. I'm not seeing that with my charts, but according to how they do it here, especially in the short term, we're seeing some real improvement there. We're still negative with bonds based on price in the short and intermediate term. We're negative with commodities and the dollar in the long term. All the sectors ended up being positive. Discretionary led the way higher, and that's encouraging. That's a growth area. That's Tesla. That's Amazon. And then we saw utilities have a pretty good day. We've been watching that. Communication was also up. The area that was up the least were materials, and that tends to be more driven by what's going on in the economy. And we saw some positive things right off the bat with the NASDAQ going above 18.2, 18.3, then it went back below 18.2, then eventually got up to 18.4. And then staples, we crossed where we had crossed below 50. Now we're crossing back above 50 there. Utilities, they're crossing below 80 with their bullish percent index as they're seeing some weakness in that area. The Dow was able to get up around the 42,000 level. And industrials, another area that's more economically driven, it crossed above 70. So we saw some improvement, but we're not full-blown positive, at least with the S&P. When we look at the S&P versus the equal weight S&P, both saw an improvement on Tuesday. The Dow was able to get back above its 50-day moving average, but we're right underneath this pivot point, and that was pretty much the high for the Dow. We've gone from negative to neutral for the diamonds. Saw some improvement here with the NASDAQ, up almost 1.43%, not 1.5%. And we're still bouncing up off of this pivot point with the NASDAQ 100. We've gone from negative to positive with the Elders Impulse system for the Qs. The momentum is still negative for the NASDAQ 100, even though it's trying to turn up slightly. We're right below the 20-period moving average, and this is the overhead resistance I was referring to. We could not get above that. And when we hit this 20-day moving average here, that's pretty much where we stalled out with the S&P as well. Small caps had a pretty good day, up over 2%, but still just coming up into the higher end of the recent range. So when we look at the Russell 2000 small caps, crossing back above 50 with the RSI, bouncing off the 50-day moving average, momentum is negative but improving for the small caps. We've gone from neutral to positive with the small caps with the Elders Impulse system. Mid caps also improved, up 1.42%, going from neutral to positive with the Elders Impulse system. The Wilshire still bouncing off of its 50-day moving average, also coming up off of the 50-day moving average with the total U.S. stock ETF. And we were up 0.93%, still slightly above the 50-day moving average with the financial sector. The FANG index was up 1.78%, still is positive, but not seeing the upward thrust. It's pretty much been going sideways. Apple was up 0.65%, but still under its 50-day moving average. Amazon looking good, up 1.9%. Microsoft is still below its 200-day moving average, and we are getting very close. We're less than a point away from seeing a death cross here with Microsoft. Microsoft's going to need to recapture this or not stay negative for very long. But a lot of people, this is what they use to make decisions. They do a moving average crossover system, which I teach in my program, but I also teach use that in conjunction with hedging. And a lot of people, if we see a death cross, you might see some increased selling with Microsoft, unless it can really have a good day on Wednesday. Google also getting near a death cross here. It was up 0.3%. Not a real big change there. Meta still above its 50-day moving average, up over 2%. Nvidia up 2.84%, still looking pretty solid there. Tesla above its 50-day moving average, up over 3.5%. And not really seeing much of a change here when we compare US stocks to world stocks on a short-term basis, flattening out after declining on a longer-term basis. Oil still up into the low 70s now. It was up slightly, not really reacting to what's going on in the Middle East. This is interesting, though. The dollar came back down below its 200-day moving average. The dollar likes the stock market likes a weaker dollar. If we could see the dollar actually pulling back a bit, that could give some support to stocks. If the dollar turns and goes back up, that might put some pressure on stocks. And we came down with the 10-year yield. We were up with the 10-year based on price. And seeing not much of an improvement between the Qs and S&P here. It's right on the moving average. Discretionary, that's looking a lot better. It's going up above the moving average, and the moving average is going up. Not really seeing much of a change when we compare large cap growth to large cap value. So with the large caps still on the moving average, we're seeing an improvement with the mid caps and the small cap growth to value ratios. Nothing really changing here, just chopping all over with the S&P to utilities ratio, chopping around, not really showing any conviction with the staples to S&P ratio. So what's our outlook? The technicals are still negative when you take them together, but they are improving. We're below the 20-period simple moving averages. That should be just SMA, not MAS. How's that for screwing up an acronym? We're still below both the simple and exponential 50-period moving average. We're going to get the MBNA Mortgage Applications Index. Not anything major at all, just something that we keep an eye on. So the market's just going to be left on its own as the parents are away. The market will play. Let's see how things end up actually going that way. The geopolitical events, which you can include the U.S. election in that for the time being. And then Thursday is going to be big. We've got the jobless claims, productivity, and unit labor costs. The Fed's going to come out with their decision and statement, and then we're going to get consumer sentiment on Friday. So they think this is kind of important according to this economic calendar. Crude inventories, which I really don't pay attention to, and the bond auction, which sometimes can have an impact on interest rates, which can then bleed over into stocks. Seasonality, we are positive across the board for November 6th with the Dow, S&P, and NASDAQ. Wednesday, though, back in 2023, it was the worst day of the week, but it's doing better. It's not as bad as Tuesday, but not one of the stronger days so far in 2024. This is Tom Bowley's research here, where we're coming up. It's going to be in the 6 now, where historically we might see some weakness here. We'll have to see how things play out on Wednesday. Then we come into a positive time, then a negative time, and then we finish the month off looking pretty strong. Seeing less of an impact with the blackout period for those stocks being able to come in and buy back their own stock. And we're still showing this with the Carson composite cycle here, looking good seasonally going into the end of the year and also into 2025. And here's how do we react around a presidential election? Quite often we'll see some weakness, then the election happens, and then historically, boom, we're off to the races after that. No guarantee that's going to happen this time, but that is what has happened before. But there's a lot of things that are happening these days that have never happened before, too. And this is the newer chart here, where we do tend to see some positive seasonality once we get beyond election day. This is the S&P around the 2020 election. So what are the warning signs? We still have this Hindenburg almond hanging out in the background. We're keeping an eye on the more defensive sectors. We still have the 5-day and 10-day equity put call ratios going up. That's more negative. And accumulation distribution, it's negative, but improving. Chaikin money flow, negative, but improving. Chaikin oscillator, extreme negative, but improving. Now we had the 50 period moving average study on here. Now we only have the 20 period moving average study that's still below 50. The parabolic SAR, Swenlin trading oscillator, the McClellan oscillators for the S&P and NYSE are still negative, and the summation indexes are still going down. The momentum is still negative for the S&P. The vortex is negative. The ease of movement, money flow, and ultimate oscillator are still negative, even though most of these charts are improving. We're looking at an improvement with the growth of value for the large caps like the S&P. Discretionary to staples is still holding up and looking rather well, but the momentum for the NASDAQ 100 is negative. Positive signs. We are showing some improvement with the advanced decline lines. I did put the NASDAQ 100 bullish percent index over on the negative side. Well, we came back above 50, so this is back over on the positive side. And even though their context, especially for the S&P, is that it's still declining, and even the NYSE is still going down. The financial sector is still positive. So what's our conclusion? We're negative but improving, below the simple moving average based on 20 periods, above both the simple and exponential moving average based on 50 periods. That's what we're seeing in the short term, but we're still negative until we can close above that. We're still positive in the intermediate term, and we're positive in the long term. Thank you. I hope you found this helpful. I hope whoever you voted for is whoever's winning. Have a really good day, and I will talk to you in the next video.